to contend with. The first one on our show is Sansera Engineering. The first management, the auto component manufacturer, reported a broad-based growth across all geographies, delivered the highest ever top line and EBITDA in the fourth quarter as well. So to discuss this and more, we do have with us B.R. Preetham, who's the group CEO at Sansera, joining in. Thanks a lot, Mr. Preetham, for joining in. It's a 20% revenue growth that you posted in the fourth quarter with a 32% EBITDA jump. What really stood out was a sharp margin expansion that you did, not only on a quarter-on-quarter basis, but year-on-year as well. So the question then is, is this 20% growth run rate likely into FY25? And what sort of margins are you targeting this year?
Thank you, Mangalam. Thanks for having me here. We are very happy that we've been able to deliver consistently over the quarters last year. If you really look at our order book, we are very confident that going forward in FY25 and onwards, we would be delivering, we are aiming at 20+% growth as well. So this also is evident in our strong order book, which is also demonstrated.
Okay. Well, sir, I just wanted to actually get some figures with regards to the order book. The latest figures we had is that it's around close to 1,600 odd crores. Is that a correct figure? And what are you guiding for when you go into FY25 in terms of incremental orders? And which segments are you expecting the inflow to come from?
Yes, Ekta, look, when we say that every year we have been resetting our order book, removing the orders from the peak order revenue that we indicate of the orders which have started commercial production. So we have removed approximately about 600 crores of orders out of the order book. And then after resetting, it is approximately about 1,600. This means that these are the orders which we are yet to execute, and this can result in a peak annual revenue of 1,600 crores when it is fully matured. So this is an annual process that we keep doing. Overall, we added about 800 and odd crores in the full year, out of which we have removed about 600 and moved it into the production this year. Primarily, if you look at our order inflows, this is coming from both auto ICE as well as non-automotive and XEV components. If you really look at our order book, it's a very good mix of, about 52% of our order book is coming from non-automotive and tech agnostic. And this is also primarily 60% of our order book is also from our international market. So there's a very healthy mix of both sector as well as geography.
Right. I remember, the last time you joined us, you did say that 17% of your business was non-auto and tech agnostic, even as most of your order book increase is coming in from that segment itself. You anticipated that this could go all the way up to 40% in the medium term. So just wanted your thoughts on by when does it go to 40%? And on margins, I didn't get your answer. You said, you would operate in a 17 to 20% band. You're at 17% right now. So do we see 20% in FY25?
No. We would be very happy if we are able to reach 20%. No, we are consistently improving our margins. And we are very hopeful that in this year as well, we will see margin expansion. Of course, as we are on the growth trajectory and a lot of our capex and resources are getting front-loaded into our growth, so you would have a certain effect of that on the margin. But we are very hopeful that and confident that our margin profile will keep improving. What was the second question, Mangalam?
That was autos and non-autos, basically the tech agnostic space.
Yes. So when we started this journey post our IPO, we were at 17% and we have set ourselves a target of moving it up to 40%. As we full year ended, it is about 25% now. 17 has moved to 25 on a much larger revenue base. Now, if you really look at our order inflows, more than 50% of our order inflows are in from non-auto and tech agnostic. So we are very confident that in the midterm, in next 2 to 3 years, we will move this to about 40% as we have guided.
Okay. Well, Mr. Preetham, it's been a great quarter for you. It's been a great year for you. But if you had to point out any kind of headwinds to growth that you could see going into FY25, certain red flags that you're certain parts of the business that you're probably worried about segment wise? Say it could be the EV segment, or even geographies such as Europe. Which one would be a point of concern or something that you're probably tracking closely, and why?
I would not put any red flag, but I would say that we have been very cautious in our, we have been closely monitoring our business in Europe. Europe seems to be, we are very cautious on Europe business, both our exports to Europe as well as our Sweden subsidiary, which we are doing, as well as, there were some headwinds in our aerospace business last year because one or two projects approvals got delayed, so we could not achieve what we had anticipated. But we are definitely very positive on our aerospace and defense business. So this year we should be able to be doing a lot better in that. But we are also cautious on certain logistics related issues which are related to Red Sea, which could impact on freight movement in terms of time and also in terms of cost, because about 31% of or 32% of our business is to our international destination. So there would be some, we are keeping a close watch on this as well.
What about debt? Net debt, if I remember correctly, is a little over 700 crores at the end of FY24. You were looking to reduce it. What's this plan here? What's the scope of debt reduction in this year?
Mangalam, we are in a very high growth trajectory, and we are expanding our, as I indicated in my earning call as well. We are expanding our product portfolio. We have committed resources into our higher tonnage of presses, which would aid our both aluminium forging as well as forgings of higher engine category. So with all these things, we are quite hopeful that we will be range bound in our net debt. It would be take away 25 to 50 crores addition or deletion based on the end of the year numbers. We are quite hopeful that as our ratios keep improving, then the absolute amount may slightly go up, but then the ratios keeps improving. So we will keep an eye on this number and act accordingly as and when it is.
Okay, all right. Well, we're going to let you go on that note, Mr. Preetham. Thank you very much for joining in and speaking with us. So that's the word coming in from Sansera Engineering, very close to